unmute myself. There we go. Hope everyone's all right. Good evening. Just thought I'd jump on really, really quickly. I said at the back end of last year that I was going to do more kind of like live sessions, maybe talk a little bit about new subjects. And this is just one that I thought would be useful to cover. I guess for those of you who are invested in stocks, particularly if you're investing in Virgin Galactic specifically. I know that sometimes when you see these news stories come along, you see them online and via Trading 212, because I know that they pinged out a notification today saying that the stock is down 15%. That oftentimes when you go and look for additional resources, some of the language can be really confusing. So what I thought I'd do is I'll do this live this evening just to talk about what's actually happening, maybe take you through some news articles and break down what that language actually means in real terms, so that if you are holding, Virgin and you are a little bit confused, hopefully it will begin to make sense. So by all means, feel free to use the questions comment section. If you do have questions, we can try and cover those as well. I'll monitor them on my side. But let's have a look and see what's going on at this point in time. So, Virgin Galactic stock is down 15% at this point in time. And the reason for that is because they are raising some additional money to help kind of support the project, support the business moving forward. Now, I will share my screen with you just so that you can get a grasp of some of the language that's being used in the news articles right now, and maybe break down what some of the terminology actually means. But what I want to do is maybe zoom out and in the wider context of things, talk about the concepts of bonds, those kind of things, and also maybe answer the question of, should you be buying this dip in Virgin Galactic? It's interesting actually, because when you look at the let me just remove this source very quickly and just get the right windows up for you whilst I'm doing this. If you start looking at the chart for Virgin Galactic specifically, this is it right here. The stock is down quite a lot. I mean, this is when is this peak? This peak is June 2021. It was at $55. We're now down all the way to here, which is just over $10 a share. And if you look backwards, really, these are share prices that we were seeing back in 2019. So it's had a phenomenal amount of growth during these periods, particularly getting up to these points right here, $55. But it's taken a huge slide in the last six months. And I know that there's a lot of content out there at the moment where people talk about buying the dip. Is this a good thing to buy on a dip? We'll probably talk a little bit about that in a moment. But if we start just to explore what's happening today and why Virgin is down 15%, hopefully we can kind of get a grasp of what's going on. So I've got this article right here. So basically, this is what's happened. The stock slid 16% actually on Thursday, according to Yahoo Finance, after announcing a $425 million convertible bond offering. So basically what's happening here is they're looking to raise a little bit more money for the business, raise capital for the business. Now, what they would typically do is they would go and raise that by issuing new shares. However, with the stock price doing as it has done, it would be very, very hard to probably get people to part with their cash on a new kind of like share offering. So what they've done is they've decided to go down this convertible bond offering. So the actual technical term that they use in the States is senior convertible note. So note in America, or in American terminology, if you convert that to UK language, it's a bond. So a note is essentially a bond. But I think it's worthwhile maybe just explaining what that basically means, because it's very, very interesting how they've actually used this instrument to raise money. And from what they're saying here is that the convertible senior notes, so they talked about bonds right here. Where was it? Convertible bond offering was the language they used in this sentence right here. Then if you go down to the second paragraph, they're saying the senior convertible notes, they've switched language very, very quickly. They're basically saying will be part of a private offering to persons reasonably believed to be qualified institutional buyers. So it's not for general public. They're going after institutional buyers. These are the people who will have the capital to essentially raise this kind of money that they're looking for. It's quite a large sum. It's almost $500 million. dollars. So, what does that phrase actually mean? Because when you look at that, you think it's mumbo jumbo jargon, right? What on earth does that actually mean? So, if you're doing a lot of research online, maybe you use people like Investopedia. They're very, very good for breaking things down, and they give you a really good explanation of what it is. But I thought I'd give you kind of a further breakdown of it all. So, a senior convertible note is a debt security that contains an option. Oh, let me just share this with you actually. A senior convertible note is a debt security that contains an option in which the note will be converted into a predefined amount of issuer shares. A senior convertible note has priority over all other debt securities issued by the same organization. Now, that right there is really, really important. This first paragraph right here. So, what they're basically doing is they're raising money for future projects for the business to get them through. And bearing in mind, they've had some issues, some real issues in the last few months. And what they're basically saying here is that this senior note has the ability to be converted into shares at a later date. But as a debt security, as a debt vehicle, as a debt instrument, it will have priority over every other kind of debt or ways that they've managed to raise money or have raised money in the past. So it gives that element of security to the institutional investors who are going to be putting the money up in order for them to actually raise the $25 million, $425 million that they're looking to raise. So it's a really, really clever type of instrument that they're basically using here. Now, going back to the chart very, very quickly, right? And I think this is really, really important because there are lots of videos talking about, Virgin Atlantic, and is this now the time to get back in and possibly buy? Possibly. I think before you start thinking about getting in here and hoping that it's going to ride back up, I mean, look, let's just try to see if we can actually zoom out a little bit further. I mean, this is the first recorded opening of this stock. When was this? This was on 18th of what? That's September 2017. That's $10.70 roughly. And we are at $10. Well, we're the low, we're actually below its very, very early stock price. Some may argue that actually the only way that this stock could go is up, but I think you're going to need a little bit more data to actually make that determination in order for you to know whether you should be putting your money into this kind of thing. Now, it's quite possible that they raise this money, they beat headwinds and some of the issues that they actually have. I mean, the big problem with Virgin Galactic is you need to have what their business model is. It's space tourism, right? Essentially, what they're hoping to do is basically shorten the time between places like the UK and Australia, where it's going to take you 20 odd hours to get there. Why? By them using that technology to basically do orbital flights, right? But the reality is that they still haven't carved out that marketplace to an extent where it's solid enough to know exactly what the size of the market is and who they're going to be targeting, so on and so forth. I think who they'll be targeting is relatively easy to establish. I mean, it will be wealthy people who are flying private jets, right, who are paying 30,000, 40,000 for a flight, but be able to charge around about the same, but make the journey quicker. But that market isn't really established right now, and therein lies a problem. And I think they've got a little bit of competition as well. I mean, you can't speak about these guys without talking about, the likes of Jeff Bezos with Blue Orbit and other players that are coming into that space right now. The space economy, the space industry is going to get very, 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 very busy and very, very competitive. I think the only people that I guess have a little bit of a march in that sector specifically will be the likes of SpaceX. But SpaceX is in a completely different kind of field when it comes to the space economy and the space industry. Elon's not really interested in space tourism or that kind of application that the likes of Virgin Galactic are chasing. He's more about that exploration of space and obviously putting satellites into orbit for companies like Starlink, which we'll be talking about actually tomorrow in tomorrow's video. So buying this right now, if you're going to buy it, I mean, there is a good chance that it will go up, but it could potentially go even lower. So if you are thinking about buying this dip, you need to do a little bit of research in terms of what's actually going on with it to really make a an informed decision. But with that being said, though, there's nothing wrong with maybe allocating a small part of your money, not putting all of it in, allocating a small part of your money if you know that you're comfortable with that level of risk. And again, don't take this as financial advice. You need to do further research. But looking at this graph right here, you can look at it either as this is an opportunity, or you can look at it as a risk. And I think with the recent performance of the stock, you have to question and just ask a few more questions around what the future plans for this business is, because that slope is there for a reason. And I think this brings me on to maybe just talking a little bit about bonds on a wider note. I don't think we talk about enough about bonds per se when it comes to the investing journey and the role that it plays in investing. Obviously, bonds and yield bond yields, I should say, are pretty low right now. And that's unfortunate, because back in the day, you would have an element of your portfolio with exposure to bonds, and that will give you the ability to almost know what your return is going to be. You might be able to get a bond, for example. This kind of bond, if you're going to put it into investment terms, will be like a corporate bond, right? An investment grade corporate bond. It might even be a junk bond, depending on the score, the credit score of this business. But if it is an investment grade bond, for example, so investment grade bonds will be issued from people like Apple, Amazon, Facebook, or Meta, as they're called now. They will issue bonds, so they will want to raise capital. So they'll offer out to the general public and say, look, if you give us £10,000, for example, and let me just illustrate this for you, so it actually makes sense. Share the other screen with you. Bear me 1 second. And they'll say, if you lend us this amount of money, we'll give you a return of X amount over a period of time. And in normal traditional investment terms, that can be very, very useful indeed. And I always explain this in regards to trying to go back to what your initial goals are. So, for example, if you had someone like Apple, for example, and they wanted to raise, I don't know, say 400 million or something, they might go to the general public and they might say, actually, you know what, for every person who gives us or invests with us, we'll give a return, or a coupon is the technical term that we would use, coupon or return, right? And they would say, okay, we'll give you a 3% return per annum for any amount of money that you invest with us. So let's just say you come along now, okay? You say, right, I'm going to put in 10K. And let's just say they do this and they put a term of 5 years on here. So what that basically means is you're going to get a 3% return per annum each year. And at the end of the 5-year term, you're going to get your initial capital back and your interest growth back in one go. And that means that whilst you know what your outcome is going to be here in terms of monetary value, which is actually quite powerful, by the way, all of a sudden, when it comes to your planning and your investing, you're able to actually account for a certain amount of money coming in in terms of your return. So in other words, over that 5-year period, you're going to get 11,500 quid back over that 5-year period. Now, that's just a loose example, right? Apple's a very, very strong business in terms of their credit score. So they'll be like an investment grade, really good credit score. They've got lots and lots and lots of cash. So the beauty of this kind of thing is, and they do issue bonds, by the way, guys, is that the risk of borrowing money to this kind of company is relatively low because of the cash reserves that they actually have, which will be reflected in the coupon or the return that they're going to be promising you, because it's as close as a sure thing as you could possibly find. It will be very, very different if you were lending to company XYZ that wasn't the size of Apple, that didn't have the financial resources the same as Apple does, and they were looking to do exactly the same thing. But let's just say they were looking to raise 40 million, and they might say, right, okay, so the coupon or the return that we will give you, because we're not as big as Apple, might be 10%. Okay, and that they'll give you that per annum, and over 5 years they're going to return your capital to you, right? Over 5 years. Let me just get rid of that 1 second. So what that basically means is, again, you come along with your 10K times 10% per year for 5 years. Well, guess what? You got 15K at the end of that, and it's a known outcome from the outset. And the reason why that's really, really important, I wanted to illustrate that, is because if we talk about risk and risk management and diversification within your portfolio here on the channel quite a bit, right? As one of those things that you should be considering when you're looking to invest, and not just putting all of your money into a place where potentially you could be at the risk of the markets. And Virgin is a prime example of this, right? So let's just say you put all of your money into Virgin Galactic, and over the last 6 months, you've seen your money just trail off, lose 70, 75% of its value. You're going to be sitting there really, really worried about your investment, because now all of a sudden you're going to be in a quarry. Do you hold the stock hoping it's going to recover? It might not recover to those same levels at $55 for 5 or 6 years, and God forbid you're investing for a house deposit, for example, right? You're then stuck holding it. Or you might have to have the real conversation with yourself around, okay, do I cut my losses? And the rule that we always talk about here is, try not to cash in losses. Yes, it's painful to see on paper, on your screen in red, but it's not real until you really cash it in. And the same thing is true for any money that you make on any investment. It's not real until you physically cash it in. And so when you talk about financial planning, the reason why oftentimes people will refer to bonds as an option that is worthwhile having in your portfolio is simply because, and I'll share this again and re-illustrate this for you, is let's just say, right, you've got a goal and you know that you need to have, let's get this on here, let's get that onto black, 15K is your target, right? And this could be over any amount of time. Okay, let's say 10 years, 15, whatever amount of time, right? But if you know, for example, that you could get a bond that will pay you 3% per year, and over 5 years, on 10,000, it's going to give you 1,500 quid. Well, all of a sudden, if you invest in 10K, right, and the difference is 5K, you know that you've already got 1,500 quid coming from your bonds. Yeah. So that gives you an element of certainty. That means you've only got a difference of about £3,500 that you need to get off the stock market. And what that allows you to do is essentially manage the risk that you're taking in the stock market. You don't need to be looking at overly risky things in order to make this happen. And it's a really, really interesting kind of like equation of how investments are generally built that I think we don't really talk about enough here on YouTube, because potentially, a lot of the videos that you will see will be buying this stock, buying that ETF. And it's really important to understand the dynamic of what bonds are there to do. Yes, granted, at this point in time, bond yields are really, really, really poor, but they are there to do a job. They're there to give you some kind of cushion, some kind of safety within your investment proposition. If you're able to get this kind of outcome where you have your known result from it, that's even better. But the diversification and the element of risk mitigation that you get from it as well is actually quite invaluable, particularly if you're working towards specific goals. So I thought I'd just go through that. It might be useful as a bit of a understanding piece and education piece for you guys. Let me just have a look at the comments. I know that there are a few in there. Darth Mike, how you doing, mate? He was just saying on here, Virgin Cola, Virgin Games, Virgin seems to have a habit of abandoning products. Yeah, I mean, I don't know whether if anybody's read Richard Branson's book, Losing My Virginity. I think it is. It's a really, really good read. Really, really good read. But yeah, I think sometimes that can be good for business and sometimes it can be bad. Being able to make decisions, like really difficult decisions, can be positive. But at the same time, if you're cutting things because they're not working, obviously that can be really, really bad if you're invested in the business and stuff. So yeah. It's saying that chart looks like a meme token pump and dump chart, but in slow motion. It does. It's really, really scary when you look at it that way. Because yeah, I mean, if you're holding that stock, and again, this is why we talk about diversification. Like, how can you not panic, or how can you not feel a certain way if you were invested in this thing? And let's be completely honest, right? Over the last 12 to 18 months, right, through the whole pandemic, when people were at home, there were a lot of videos about Virgin Galactic and you should buy now and it's going to 10x. It's going to perform really, really well. Imagine you got in here, right? Imagine you got in there, having done no research of your own. You just followed what people were saying. You got in here. Your journey from that point would have been absolutely horrible. I mean, just imagine that. And the thing is, if you haven't done your research on a business and this is the only thing that you put a large chunk of your money in, or it holds a large position, in your portfolio, you then start getting to the point where you become optimistic about it. And this is why revisiting some of the things that you're holding is really, really important. And people think it's like you can just buy it, just leave it. Yeah, you should, but if you're investing in individual stocks and you're managing it yourself, it is your responsibility to monitor this kind of thing. Because if you got in here and you're down here right now, it's a really difficult place to be. It's a really, really difficult place to be. And there'll be people who are holding this right now like this, who may have just invested with no research, but could maybe watched a few videos online and thought, right, I'm going to add it in. It's a difficult one. I don't really know what to say to that, really. It's down to each and everybody's own preference, but it's not a nice journey to be on. It's not a nice journey to be on at all. Look at this one. Let's get rid of this. What's the best ETF at the moment? Also, can you choose what stocks you put money into in the S&P 500? And in layman's language, what do we look for when knowing what stocks to invest in? I can't answer that in a very brief question, in a very, very brief answer, purely because that question right there is loaded. You've got ETFs and you've got stocks in there as well. But let's just take them one by one. And let me just get the other thing up and I can try and illustrate what I'm going to say in response to your question. So you've got the visual aid to it as well. Now, the first question is, what's the best ETF at the moment? Right. So it really depends on what kind of ETFs you have. There are thousands upon thousands upon thousands of ETFs potentially out there. So I can't tell you what is the best ETF because I don't know what your investment goals are. I don't know why you're investing. I don't know anything about you to be able to say this ETF is the best one for you to go and get. There are some ETFs that will, from a composition point of view, be very, very favorable to first-time investors. You've referred to here the S&P 500. Now, the S&P 500 as a kind of like an index is a pretty good one. It's the top 500 companies in the world. They are the richest. They are probably the most established companies on the planet. So they're a good place to start. But you're asking here, can you choose what stocks you put your money into in the S&P 500? The answer to that is yes and no. So if you're buying it in an ETF, no, you can't. If you want to go and buy the individual companies on the S&P 500, then yes, you can. Which leads on to your last question, which is, in layman terms, what do you look for when knowing which stocks to invest in? So the first thing you need to be bearing in mind when you're looking at a company is, well, let me just see if I can actually just illustrate this 1 second. So let's just say, for example, right, I'm going to talk Tesla because I love Tesla and people know that I love Tesla and I'm not going to apologize for it. So let's just say it's Tesla, right? And I use two examples for this because they can be diametric opposites. So let's just say Tesla, right? So the first question I'm asking about this company is, what do they make? What do they sell? And this will apply for any company in the S&P 500. What do they sell? First question. Okay, so for Tesla, it's cars. Okay, so if they sell cars, are the cars any good? Are their products any good? Right? Is the product good or is it bad? Because if it's a bad product, well, then all of a sudden you're going to have customers who might buy it, but they won't be repeat customers, and that is really, really crucial for business. Okay, so if they're selling really, really good product, well, then you're going to start asking, well, how much money? How do they make their money? Where does their money actually come from? So are they making good money? Are their revenues growing? Are their revenues declining? Revenue is a really, really, really big indicator. Sometimes it's all being important, but it's not the most important metric that you'll be looking at, but it's a very important starting point. Revenue, that's cash into the business. Okay, so how much are they making? In business, your revenue can be great. So you could have a business with 100 million turnover, right? Revenue is also called turnover, but they might have expenses of 150, right? Expenses. This is simple financial principles. Okay, this even applies to your own personal finance, right? Let's imagine you earn £1,000 per month, but you have bills for 1,500. You're in debt. The same thing applies for a company. If a company is spending more than it makes, they're running a loss, then That in itself could be a really bad indication. I use Tesla for this one example because for years and years and years, when Tesla first went on the market, first IPO, when was it? 2012, I want to say. It might be a little bit earlier than that. It's about 2012, roughly 2011, 2012. They were not making any profit at all. Now, the difference between a good company and a bad company, and you won't necessarily be able to tell this if they are in negative revenue or profits every single year. What is the map to get them to profitability? Tesla had a map to profitability. They had a certain set plan of what they were going to do. And if you ever watched any of Elon's early videos or looked at any of the early coverage of Tesla, yes, they questioned when is it going to be, when is it going to be profitable? But there was a plan. There was a plan between the product development and how they were going to take that. There was a plan, and there still is a plan in the business around how they're going to actually bring and increase the production and increase margins through that. So revenue is really, really important. If you are able to pick a company that is making profit, that is one of the most, if not the most important metric when you're trying to pick a company, because you do not want to be picking a company, preferably, that is at a loss. Good businesses, and most of the ones in the S&P 500, well, all of them, in fact, are making profit. So those are the key things that you look at. Yes, then you can start having a look at who their competition is and whether they have any threats from a rival company and how much advantage do they have over said competition. Okay, so for example, with Tesla, probably a rival that people often will reel off will be someone like NIO. It's a Chinese EV company. If you're looking more domestically into Europe, they've got competition from the likes of BMW and Audi and Porsche. But what is their strategic advantage? Why is it that BMW, Porsche, Audi are likely not going to be able to compete with Tesla in the future? That is all around the fact that they've started way earlier. They created this space. They have first movers advantage, and they have infrastructure and technologies that are way above everybody else and ahead of everybody else. That is their strategic advantage. If they have that, fantastic. People who are actually behind the company, so who's the CEO, who's on the board. I tell you right now, if it wasn't for Elon, I doubt very much that Tesla would be where it is right now. So the people behind the business are very important. Do they have a team of people with the right amount of skills to be able to take the company forward? This may sound like really in-depth, like boring stuff to go and find out, but it is necessary stuff for you to go and find out. Yes, you can start talking about PE ratios and earnings per shares and all those kind of things. Those are part of the research. But this, for me, is the biggest indicator. These are the things that I look for specifically around what they sell. Are the products any good? Do they have any competition? What's the team like? High level accounting, are their revenues increasing in every year on year, or are they declining? If they are declining, why are they declining? They might be declining because they're advertising and they've got more cost of sales. If that is the case, that's fine, because that could be an investment into the business that may manifest in increased values later on. But you want to try and get underneath all of these things. Now, with this all being said, right? If you've listened to me say all of that, and all of this is absolutely blowing your mind, and you're like, oh my God, it's way too much work, like most people often think and come to realize when they get into the deep end of this kind of stuff. If you don't understand it, the best thing for you to do is what you're asking originally: ETF. Why? Because an ETF is going to be a basket of companies. You can get an ETF of the S&P 500 where you basically buy this basket and you own each and every single one of the companies in the S&P 500. You don't have to do the research. You don't have to be bothered about doing any of that. If you're using someone like Vanguard, or you're using someone like BlackRock, which is iShares, or if you're using someone like Invesco or someone like, I don't know, Fidelity, they will do all of that research for you. The pinch is, you do not get to dictate what companies and in what proportion your money is invested in any of these companies inside the ETF. You don't get the freedom, unfortunately. So that's a very long-winded answer, but I hope a useful answer to give you. that hopefully puts some context around things. There is so much content on the internet right now. There's not a lot of context. And I like to talk about the context because quite literally the devil really is in the detail. And unless you know these things, you have to be able to put your best foot forward and make an informed decision. It's why I go into the detail that I do. I know sometimes my videos are really, really boring. They're not upbeat, but I think that the detail is really, really important for people to be able to make a really informed decision. But, I would say to you, please try and understand what your goals are before you go and do anything. If you're investing for a home, for your deposit, timeline, right? How many years from now is that do you need that money back out? You really, really do need to bear that in mind, because you don't want to invest money into something where what's happened with Virgin happens, then all of a sudden you've got to put off your house deposit and then you're basically scuppered. You really need to think about your goal, how long it's going to take, and then take a pragmatic view around how you're going to invest in order to achieve that. Financial advisors are there for a reason. They do a good job, but they do cost a lot of money sometimes, and a lot of them do have minimums. They're there to do a job. But if you don't, have the ability to go and see a financial advisor, I do some coaching to help people, guide people on the decisions that they're making so they can at least try and make a better informed decision in more detail, ask you questions about you. I think that's really, really important. But there's a lot of stuff on this channel that will help you, which is just basically just free content. So you can use those as a source as well. You're saying that you're only investing through Trading 212. They do have ETFs in Trading 212 as well. With Trading 212, if you're predominantly investing in individual stocks, I hope that you're doing your research. Please do your research. And it's not just about watching videos on YouTube. You do kind of need to understand that basic stuff. Within Trading 212, you can build pies. If you're building a pie, being able to get a diversified pie across the different types of companies and different types of sectors, different types of industries is really, really important. And also perhaps to a certain extent across different regions across the world. The S&P 500 is an American index, basically. All of the companies are there in America. America is the strongest economy in the world, but if anything were to happen to that economy, then potentially you have all of your money in that one region. So diversification across different areas globally is sometimes and is often advised as the best route forward. That's one thing to bear in mind. I mean, you can do that within Trading 212, but please just be meticulous with the detail that you look for. Also, bonds go up when stocks go down, and you can sell your bonds if there's an equity crash to buy equity. Nice little hedge. No one talks about them because they're boring. That is very, very true, Ned. I mean, so let me just illustrate this as well, because what Ned has just said there is absolutely true. I mean, we used to use the term correlation, right? Non-correlated assets. And now we're going to get into technical jargon. Don't worry about the sound of that term. But basically, when I was being taught this, when I first started in the finances, the guy who taught me, we used to talk about a seesaw, right? So you have a seesaw here, yeah? So as if one side goes up, this side should go down, right? That's the simple premise of it. Well, what they try to do here, and what the way it was explained to me was, well, if you have equities on this side and you have bonds on this side, they have a non-correlating effect. So if this one goes up, this one will go down. If this one goes up, this side will go down. And what you should try and do is, if you're able to do this correctly, and this is what the professionals will try and do, is if this seesaw and this balancing mechanism is your risk, they want to try and balance you as much as possible. So that from a risk point of view, if this goes up, all right, you might see a little bit of a drop here, but you're getting more growth here. But more importantly, if this goes down, you've got a hedge for the downside risk on this side. It's about balancing the two things. And that's the role of a bond within an investment proposition, within an investment fund. If a fund is built professionally for you, that's the whole purpose of it. This goes out the window because it's boring. It's not sexy, but it has a really, really, really important role to play. Particularly when we start talking about income generation and all that kind of stuff, it can be beautiful. That combined with things like, dividend stocks and dividend ETFs can be really, really beautiful in that journey. I'm just sorry, guys. I just realized you couldn't see any of that as I was going on. But let me just recap. So basically, what I was saying is this is your seesaw right here. This is your triangle. If that is your risk, equities go up, bonds go down. You're going to make more money in the equity side of things right here. So the idea is if the equities go down, this goes up and gives you a bit of a hedge. The whole idea is you get a really nice balanced approach when it comes to your risk. So that regardless of where this basically moves, you're not going to bear too much loss on either side, either in bonds or in equities. That's the whole point in a nutshell. Hopefully that visual now makes sense that you can actually see it. All right. Let's have a look and see what else we have. Manolis is saying he lost faith in that company, sold it as a loss, and transferred the fund to another company. Look, you've got to make a call sometime. You really, really do. You've got to make a call sometime. And sometimes it's a hard call. But the point is, don't get to the point where you can't make a decision. If you've got to make a decision, make that decision because that is a really, really horrible ride to be on. Only space company I invest in is Tesla. Well, Tesla isn't technically a space company. SpaceX is. Look, you need to watch the video tomorrow because I'm not gonna give too much away right now. Watch the video tomorrow. If you are holding Tesla, then there is something else that Elon involved with that might mean that if you're holding Tesla stock like I am, you get first dibs. And if Elon does that, like people are gonna be annoyed. But hey, if we profit from it because we hold Tesla stock and we hold faith in the company, listen, I'm more than happy for that to happen. I still honestly think that Elon is going to be the first trillionaire in human history, purely because of some of the stuff that he's invested in. I mean, that he's involved in. I mean, look at it. He's got Tesla. He's got SpaceX. He's got Starlink. He's got the Boring Company. He's got Neuralink. Right? Which one? How many of those companies are actually publicly traded companies right now? Tesla is the only one. I've forgotten one as well, which is the solar. Is it Solar City? Tesla is really the main publicly traded one. So imagine Neuralink goes public, Starlink goes public, SpaceX goes public. This guy's already worth $200 billion just on Tesla alone. If I'm going to bet on anybody, I'm going to bet on Elon. I'll tell you that right now, 100%. And it's just exciting what he's building. It really, really is. Some people call him a mad scientist, a mad kind of like guy. And like he's not perfect and all that, but you've got to admire what he's been able to achieve, and just repeatedly so as well. Like he's got a demonstrable track record of just building companies, creating companies, and selling it on. And that's why I said, like, I honestly don't believe that if he wasn't behind the wheel of Tesla, that the company would be as successful as it is right now. It's just astounding what he's been able to do. Yeah, sorry, mate. I just realised that you couldn't see it. So hopefully that little recap was useful. I tell you what, mate. Listen, I only got this last week because I started thinking over Christmas and New Year's when I was away, thinking there must be a way that I can illustrate concepts when I'm explaining things on YouTube. So I did a bit of reading and stuff like that, and I was like, okay, if I buy this, I know that I can actually get this to work. So this will be a theme in a lot of my lives, just to be able to illustrate things. So because for visual learners, and I'm a visual learner myself, if I can visualize something, I can take it in. For visual learners, this is really, really good. So yeah. Let's see what else we got. Okay, I think that's it. Yeah, I mean, I'm saying here, I think active funds like Money Farm are good due to the diversification, a team of experts that make changes when times are hard. Yeah, I mean, look, the whole argument between active and passive management, like the thing, I say this all the time, right? You should not just go and invest purely because of cost. I mean, cost is an important. Don't get me wrong; it really is an important factor when you're investing, but it shouldn't be the end all be all. If you're the kind of person that might be nervous when markets kind of like fluctuate and stuff like that, then maybe an active approach is right for you. Some people say that active managers don't outperform the markets. Actually, some of them actually do, and picking them can be maybe pot luck sometimes. But that's where you do your research. That's where you kind of try and look at their track record, right? You back test them and see what their historical performance is. It's no indication to what happens in the future, but it does give you an idea of how they performed when markets haven't been as kind or when conditions are really, really hard. And just having a team of experts, if you're the kind of person that doesn't have time to analyze stocks, making those decisions for you is really, really important. And I think a lot of people also forget that, if you're not making money within your investment, they're not making any money at all as well. So they kind of have a vested interest to make sure that your portfolio grows, because their fees are based on your value, your investment fund value, right? So if your investment fund value goes up by 10%, well, their fee goes up proportionally by the same amount. If your portfolio falls by a certain amount, then they're also going to be taking a hit as well. So I think it's really, really, really important just to bear those two things in mind and be pragmatic when you're approaching this type of stuff, really, to be fair. But there you go. Anyway, I appreciate you guys for joining us. It's 41 minutes past 9. We've got a video tomorrow. I will see you then, and see you for a live on Sunday evening. Have a good evening, whatever it is that you do. And if you're watching this on repeat, thank you so much for dialing in as well. Catch you later.